Hey everyone, welcome back to another episode of Full Disclosure. Very, very special show today. We're thrilled to have with us a towering figure in the stock market. And our conversation will center on mastering this financial landscape of 2024 and beyond, with a keen focus on dynamic strategies today with specific stock ideas for you to consider in this current market. And an interesting way to look at gold investing that does create cash flow. You want to hear this, and his recommendation may surprise you. So whether or not your investments are tied up in a 401k, an IRA, or you're contemplating your first step into the market, this episode is specifically meant to empower you with the essential insights for success and substantial wealth accumulation. Folks, here we go.
If you have concerns about your financial future, let's be honest, the world shapes your wallet. We're taking you behind the scenes to look at what's really happening in the real world. Inform, prepare, and empower. This is the Full Disclosure Podcast with your host, John McGregor.
Before we get into it, don't forget to ring that bell below and hit subscribe. Also, would love to get your comments or feedback. I love to hear what you guys are thinking and where you're finding opportunities, especially today in this market. Also, you've heard me say this before, my cash flow and wealth building system has been extremely popular, where I teach you a very simple wealth building strategy using stocks and options to generate instant cash flow on every single trade. And by the way, this is not day trading. And you've heard me say this before. This is the absolute 100% truth. It's the exact same strategy my 93-year-old father, well, soon to be 94, very soon, uses to this day to generate $15,000 to $20,000 per month as a hobby. And he's been doing it for the past 13 years consistently. And of course, I use this system myself very successfully. And you can check out an overview, a brief overview at go.johnmacgregor.net. Go.johnmacgregor.net. I think you'll find that interesting. All right, so let's get into it. It is an absolute honor and privilege for me to introduce my good friend, Anthony Eichler, to the show. Anthony's a 30-year veteran in the stock market who brings tremendous insight into the markets and how to identify winning stocks. Anthony is my go-to guy for stock market analysis, insight, and stock ideas. So with that, Anthony, great to have you on the show. I know you're highly sought after, and your time is very sacred. So we really, really appreciate the time. I thought what we'd start off, Anthony, why don't you just tell us a little bit more about your background, and your family is a huge legacy in Wall Street. Maybe share some of that as well.
Well, thank you for having me, John. I really enjoyed our last conversation a quarter ago. A lot's happened in the last quarter. Personally, for me, I'm a third-generation Wall Street person. Both of my grandfathers started on Wall Street. My father ran a firm. My father's firm was started in 1932 because of Glass-Steagall and because of the legislation to separate investment banking from commercial banking. So we go back a long time. I started on the floor of the New York Stock Exchange in 1988, where we worked on the retail and institutional part of the business, on the asset management side of the business, and currently I advise clients today. I don't think in my career I have seen an inflection point like we're where we are today. And I think a lot of these things that I mentioned maybe on the last time I was on your show, we'll cover some of those and what's transpired and where we're going. I think the most important thing for investors to understand is, where we're going and what happens next. And so I look forward to our conversation today.
No, it's a perfect setup for what I want to talk about. So the overarching theme today that I said earlier is really how to make money in the stock market, bottom line right now, despite all this economic uncertainty that we're seeing, and where can people find value today? So Anthony, I want to start macro, sort of the big picture of what's going on. And I've got a lengthy list of so many things that are happening today, really unprecedented. I don't think we've ever seen in a very, very long time. First, for starters, we have this Ukraine war going on with Ukraine and Russia, and I don't think there's an end in sight, and that's probably intentional. We now have this Middle East chaos that's going up in flames. There's a lot of talk of China's on the move and will do so while Biden is in office before he leaves in the case he loses the election. And by the way, I still don't think he's going to be the Democrat candidate, but that's for another discussion. China has come out and blatantly stated that they will reunify with Taiwan. They didn't say they want to, they said they will. And our own Admiral John Kirby, who's a spokesman for the White House, you see him on TV all the time at the podium, has said, we do not support Taiwan's independence, Unbelievable. That was a direct quote, and he said it many times. And if that's not a ticket for China to invade Taiwan, nothing is. You have the ability for people to buy homes at a 4-decade low, as mortgage rates are now at 7% and home prices are through the roof. And I've been saying this on the show for well over 6, maybe 9 months, that inflation is not coming down. In fact, the opposite, despite what Jerome Powell says, who in my opinion is just plain politics to keep his boss, Joe Biden, in the Oval Office. Gas prices are now rising again. Our debt is about to hit $35 trillion with a T. It was $26 trillion when Biden took office 3.5 years ago. We're adding $1 trillion in debt every 100 days. It's mind-blowing, and this list continues, so please stay with me. And with interest on that now exceeding our defense budget, and at this pace of our debt, which would be projected to hit $54 trillion in the next 6 or so years, at 5% interest, that's $2.7 trillion just in interest expense alone to service that debt. We only take in $4.7, $4.8 trillion in revenue. It's crazy. We have an insane deficit spending. We're spending $2 trillion more than we bring in every single year. And now the numbers came out a few days ago. Growth has slowed significantly, coming in at 1.6% or GDP for the first quarter, as opposed to the expectations of 2.4%. That's a huge shocker for everyone. And now we're entering this period of stagflation. And stagflation is high inflation, low growth, and it is not a good place to be. We have the invasion at the border. There seems to be chaos everywhere. And on top of that, we have a president who doesn't know what year it is. So, Anthony, with that lengthy and rosy setup, help us all make sense of this. And why don't we start with your big picture analysis, and then we can dive into the more granular and then get to the specific stocks that you like right now. With that, thank you.
That was a heck of a list. I think about all the things that, and you used the word chaos. There does seem to be chaos in the world. Mm-hmm. The deficit spending is one part of that, and I think that's one of the most dangerous aspects of what's going on. I don't think there's been a time in my career, in my lifetime, that has been more dangerous as an investor, as a someone who looks at long-term economic growth and opportunity. I think we're at a real inflection point, and which direction we go will be decided, over the next year or so. But you're absolutely correct. The deficit spending is unsustainable. This is the most predictable financial crisis we'll ever see in our country's history. And so there are things that you need to do to protect yourself. When you mentioned the economy, not all is bad, right? We're still growing. We're growing very slowly. I think the number out of the last quarter, fourth quarter, was 1.6%, was disappointing for sure, especially with the amount of money we're spending. But, we have to look at this world. Yogi Berra said it best. Predictions are tough, especially when they're about the future. And we have to look at this world today and say to ourselves, among the chaos is opportunity, right? You don't get great opportunity with a rosy consensus. And you get opportunity when there's, Warren Buffett used to say this, when there's blood in the streets, when people are really scared. Because remember, John, 70% of investment behavior is driven by fear. Sometimes it's the fear of losing out and missing out on making money. But most of the time, that driver of behavior is fear of losing money. And I think at this point, with the amount of money we're spending, with the risk to our economy, a couple things just came out in the last 24 hours. One, if you looked at something as simple as Starbucks earnings, you see a significant drop in foot traffic and revenue. Sales are down 4%. Earnings are down more than that, because for $5.50 to buy a cup of coffee, the consumer himself is being swallowed up by inflation. And if you look at other retailers like CVS that have announced earnings, they've been down. The consumer has been pushed to a point where it is very difficult to, on a day-to-day basis, survive with your monthly income. And so you can see that the consumer is struggling. And you couple that with 43% of small businesses in the United States couldn't pay rent in April. They're late on their rent. Small business is about 42% of our GDP, and our GDP is around $27 trillion. So small business makes up such an important part of what's going on. And I can add to that, you can look at, late payments or on cars and credit cards, and you can see that there's a consumer that was flush with cash in maybe 2020, after all the COVID and everybody staying home and the government handouts, to where we are today. And the inflation is not going away because the deficit spending is not going away, because there's nobody that in the political realm that's even talking about curtailing spending. And of course, with the mandates, with energy and everything else, it's going to be difficult. But that doesn't mean there aren't things that you can do, and there aren't places to make a lot of, I think, a lot of money, maybe once in a generation opportunities in certain areas of the market that we need to talk about.
Perfect. That's exactly what this show is all about, is finding opportunities in the midst of uncertainty. So I'm glad you teed that up. But I wanted to follow up with you on that, is the consumer and how they're doing more specifically. And we talked about housing, Starbucks. We're seeing traffic flow really go down quite a bit. CVS as well, delinquencies in debt, and massive amounts of debt, especially at interest rates where they are. It's really squeezing the individual consumer. So two-part question. First, have we seen this movie before? I mean, have we seen this in, historically speaking? I mean, are we looking at the 1970s again? And then secondly, what about all these regulations that the Biden administration is jamming down our throats, more so than we've ever seen? It's like he's on this last blitz before he potentially leaves office. All these EPA regulations and environmental regulations, and now we're looking at massive new taxes being proposed, both on the corporate and on the personal side. That's what I talked about last week. So again, two-part question: have we seen this before? And secondly, what about all these regulations and tax proposals?
First question: have we seen this before? We have. We saw this exact scenario play out in the 1970s.
Oh, boy.
We had stagflation, so we had slow growth and inflation. The Fed tried and failed to raise interest rates, then lower them. They lowered them too soon. Inflation came back. Energy prices shot up. It was a very, very difficult time to make money. In fact, if you look at 1964, the stock market closed at 864. By 1981, it closed at 865. The market went up 1 point in 17 years.
Wow. And
the reason for that was the inflation that had been, sort of flung on the U.S. economy, and the Fed's only response to that was to raise interest rates and slow the economy down, choke off the spending. Inflation is too much money chasing too few goods, and they never got a handle on that, and that formal inflation didn't really break until 1982. Mm-hmm. So when Reagan gets elected in 1980, he proposes cutting taxes, the top marginal rate, from 70%, if you can believe it, to 50%, which ultimately got cut to 28% in 1986. And then we saw the deregulation of the economy, which is the inverse of what we see today. So we freed up oil and gas drilling. We freed up regulations with airlines. And in August of 82, the stock market looked back and went from, the mid 800s to 2,700 in about 6 years. So we've seen this movie before. We know what happens during the 70s. We know what you should own. We know why you own what you should own in those times to protect your capital with higher rates, deficit spending, and really a devaluation of your dollar, of your money.
Anthony, it's amazing. We've seen this movie before, the 1970s, which was awful. The market moved 1 point, as you said, in 17 years. So we know what happens historically, and yet we're doubling down on exactly what they did to make it worse. Adding more regulations, and we're increasing taxes, which is exactly the opposite of what we should be doing. It's mind-blowing that this is what these people, these leaders that have so much power over our wallets, are doing to really just wreak havoc on our lives. It's really, really sad.
It is, but there are things John, this is the great thing. There are things you can do to take advantage of this.
Yep.
We can't invest in the world we wish existed. We have to invest in the world that it actually exists today. And in the world that exists today, what are we going to do? Where are we going to look for opportunities and value to not just protect my assets, but to grow them? And what things are going to do well? You look back at the 1970s, and I go back and say, well, what didn't work? Well, we know that back then we had something called the Nifty 50. They were the 50 largest corporations. It was Eastman, Kodak, and Polaroid. It was, all these brand name companies that had been bid through the roof. And what also happened that worked in the 1970s, it was oil and gas, It was oil and gas drilling companies, and it was commodity companies and real estate. It was hard assets, right? So you depreciate your dollar, you depreciate the value of your currency, you increase interest rates, but things that are intrinsically in shorter supply, whether it's gold and silver, platinum and palladium, I love all four. Real estate, things that are real hard assets, those things in value increase quite a bit. So if you were an investor in the 1970s, you made money in oil and gas, you made money in gold and commodity stocks and the commodities themselves, and you made money in small cap. I want to touch on small cap because I think that's a big, important part of where the opportunity lies. Small cap today, if you look at the market capitalization of our entire stock markets, big, small, and in the middle. Small cap today is 4% of the market capitalization.
Anthony, can I chime in? Can you just define what small, mid, and large cap means?
Sure. So we define small capitalization companies less than $2 billion at our firm. We look at companies that are 100 million, maybe 200 million. Used to be smaller than that, but our economy is so much bigger. But smaller companies with smaller valuations, sometimes they're 30 million, 50 million, 100 million. But the smaller names, in the index, it's called the Russell 2000, and that's 2,000 of what we consider the universe of small capitalization names. And it is that universe that has never been cheaper. So we have, on the one hand, at the top end of the stock market, 34% of the assets, the value of the S&P 500. 34% of the value of the S&P 500 is just in 10 names. It's never been that concentrated in history. We got to about 30% a couple of times. Last time in 2000, for instance. But we haven't had this sort of massive over-allocation to 5 or 6 or 9, or in this case, 10 names, to maybe the exclusion of everything else in our business. And that is as a direct result of passive investing. People buy an S&P 500 fund. It's what we call capitalization weighted. They give the fund $100. $34 goes into those top 10 names, and the rest of the money goes into the other 490. And so the growth of passive investing, index investing as it's called, has created this dislocation and created tremendous opportunity for people who are looking to looking for businesses and companies trading at discounts to fair value.
That's really interesting. I mean, we've talked about this before, the huge concentration, what we call the Magnificent Seven, right? But now you're saying it's 10 names?
Well, it's 7 or 10. I use it now. It's easier. Last time we talked, I just wanted, and I mentioned this Magnificent Seven having a market capitalization of $11.4 trillion, and in the that would be bigger than the 3 or 4 of the largest economies in the world. Our economy at 27 trillion. But let's look what happened. Apple's lost $400 billion in market cap. Nvidia $300 billion. Tesla $300 billion. Meta's lost $220 billion. Amazon $190 billion, and Google $70 billion. So since our last conversation, and we talked about this heavy concentration in these big technology names, they've begun to sell off, and they've shown. I know Meta did last week. They've begun to show some vulnerability, and that's because everybody's in them. Everybody owns them. Everybody owns them as much as they can. And as I said earlier, you pay a huge premium for a rosy consensus, and the consensus is these stocks are the greatest companies in maybe history. And as a result, they've been bid up to prices that I believe are unsustainable. Yeah,
I agree with you totally. Can we just take a step back and explain to the audience what drives stock prices? What makes stocks go up?
It's a great question. And the person who really did, I think, the definitive work on this was Dr. Jeremy Siegel at the Wharton School. Sure. And Dr. Siegel went back 200 years, and he looked at the growth of the stock market and the growth of corporate earnings. And the long-term average growth of the stock market was about close to 10%. And when you back out inflation, it's 7%. And the growth of corporate earnings, same thing done, was exactly 7%. So what drives earnings, what drives stock markets over time is earnings. And what makes your business valuable is how much money it earns. And I use the analogy a lot of times with restaurants. You could have the greatest food in the world. You can make the best steak, the best pasta, but if nobody comes in, sits down, and pays for your food, you're going out of business. And ultimately, what makes a restaurant work is that you are able to sell great food and at a great profit and make money doing it, which is a hard thing to do in that business in particular. But in general, what makes a business valuable? When you and I and the public go out and buy a stock, we say we're going to go buy, I don't know, Apple Computer, let's say. We're buying Apple Computer. And it has a $2 trillion valuation to it, or $3 trillion. You say to yourself, my partners and I are valuing this business for this much money. And it's no different than if you got a partner and you were going to buy a Dunkin' Donuts franchise, right? Well, you'd say, well, we're going to pay $5 million or $1 million or $500,000 for this business because it's generating how much money? And it ultimately gets down to profits. All any business is worth between now and Judgment Day is what it earns over time. And so all the stock market's worth between today and the future is what's going to earn over time. The last way you can think about this, and the way I like to, because it was something that I learned from Warren Buffett at the Berkshire Hathaway meeting. If you look at the U.S. economy over the last 50 years, in 1960, we were a $500 billion country. In 1970, we did about $1 trillion in GDP. 3.6 trillion in 1980, 6.4 trillion in 1990, about 10 trillion in 2000. Today we'll do roughly around $27 trillion in gross domestic product. Corporate profits make up 5 to 7% of GDP historically. So 7% of $500 billion is $35 billion. 7% of approximately $30 trillion is a little over $2 trillion. So corporate profits from 1960 have grown from $35 billion to almost $2 trillion. And the stock market has grown, bumpy as it may, over time to reflect that growth in corporate earnings. And that's essentially why stock markets go up over time. So in the short run, it's a popularity contest, right? It's driven by emotion and feelings. But in the long run, it's a weighing business and it weighs earnings. And so earnings drive stock price over time.
Beautiful. I think everyone can tell right now why you're so sought after and why you're such a leader in this space. I mean, the information you have is amazing. I just learn so much from you every time we get into conversation, whether it's here or privately. So thanks for that. So everyone, just so you understand, and I like to say that earnings or profits are the mother's milk of stock performance. So when you're looking for stocks, you want to look for stocks or companies that are growing their earnings. That'll put you in a much higher probability of success than just winging it or getting a stock tip from someone you work with. So on that note, Anthony, I want to ask, before we get into the specific areas, the sectors, and the stocks that you like, how do you identify stocks? How do you find stocks that other people aren't looking for?
You know, I having done this my whole life and been involved with it, I really like to go and look for things and look at the world differently, kind of look at things invert. I would say the word is invert. So, and I'm going to draw a metaphor for you because I love it. If you and I went hiking and we got our fishing poles and we knew we had to hike up this hill and the mountain's not too big, and we went to a fishing hole and we saw 25 fishermen out there with their lines in the lake, and we said, "What?" You and I would say, "Well, obviously this is where the fish is, right? Because there's 25 people also out there fishing." And we would assume, well, let's throw our lines in too. We'll catch fish because there's safety and camaraderie. But if you and I took an extra minute and we looked at our map and we said, you know what? There's another fishing hole, a little higher elevation. We can hike up a couple more miles and let's just go check that out first. And we hike up 2 miles and all of a sudden we get to this empty fishing hole. We walk up to the water and we look in the shallow end and it's just teeming with fish, right? They're everywhere. And you and I would look at each other and go, oh my gosh, we found it, right? There's nobody here. There's you and I. It's teeming with fish. We get our poles out. We start pulling out big trout. We'd be sitting there thinking, oh my gosh, you know, by spending a little extra time looking at our map and making an analysis, we took that extra step and we found tremendous value, right? And the next question you would beg yourself is, do you call all your friends and say, come up here? Or do you fill up your baskets before you tell anyone, right? I think, selfishly, if you're working on Wall Street and you think you found something, like you probably have 7 or great ideas in your lifetime, like really good ideas. And if you think you found one of them, typically you're like, I want to make sure that I get this right and I own a big enough position that it can make a difference in my life. So, but I think investing that way. So if everybody's buying technology stocks and everybody's got to own AI, I say to myself, well, that can't be a good idea because it's fished over and every analyst is covering it and I can't add any value. And so typically, historically, I like to find great merchandise at half price. I want to buy a business. I want to walk up to somebody and say, hey, here's 2 quarters for your dollar bill. And I want the guy to smile at me and say, sure, I'll take that deal. And I'll go, so will I, right? Give me your dollar for my 2 quarters, and I want to do that all day long. And so what you find is that changes over time. Sometimes it's in commodities like it is today. Sometimes it's in energy today too. Sometimes it's in technology stocks, right? After March of 2000, we blew up all these technology stocks, and there was tremendous value. There were stocks trading less than cash. So you have to be somewhat agnostic. You can't love pharmaceuticals or love technology or love energy or love consumer staples. You have to let the market and where opportunity is, and then seek that opportunity and kind of have your own proven track record in terms of, hey, what are how do I value this business and what do I think fair value for it is? Remember, last thing I want to say, all rational investing is value investing. It's about doing sensible things at sensible prices, right? We are rational investors in our country. That's why we go to Costco. We don't go to a car lot without knowing that car I want to buy, that new Buick, is not $5,000 more than the lot down the street. We check that. Mm-hmm. We don't. Again, I think we've talked about this, John. We don't apply our Costco standards to investing in the stock market. We do. I know. And that's to our detriment, and it hurts us. But you say, where do I go find stuff? I try to go where everybody else isn't looking because that's where I'm going to find the value, and I think I'm going to get the returns.
There's just so much to unpack there. I mean, I love the Home Depot, the Costco analogy and that comparison. We've used that a lot.
Yeah,
but most people won't do that, because a lot of it's the fear of missing out. They hear of this hot stock, they see it at an all-time high, and that's when they want to get into it. I also love your fishing hole example. I mean, that's just perfect. It reminds me of surfing in Hawaii. As you know, I grew up there, and we'd go out and we'd see a crowd of people in the surf, and we're like, no way, we're out of here. We're going somewhere else. Right. We're going to go find our own spot. And by the way, speaking of Jeremy Siegel, great book for everyone to pick up. Stocks for the Long Run. And he's updated it several times. And both Anthony and I have had the pleasure of being able to travel with Jeremy Siegel. And that's always an adventure. We could tell stories.
We could take.
Great guy. So Anthony, before we get into the specific sectors that you're in, and by the way, I want people to realize one thing that I hope you picked up on is when you're investing in the stock market, you're not just buying some stock. You're actually buying a business. You got to think about it like that. You are buying a business. And that's why I think it's so important to view. Let me just back up again. Another thing I want people to pick up on is that when you're investing in the stock market, you're not just buying some old stock or some hot stock tip. You are actually participating in a business. You are now a business owner, and it's a complete different mindset than what most people have. So with that, Anthony, can you boil down your investment strategy to a couple of bullet points when identifying stocks? Are there 3 to 5 things that you're looking at specifically? And then I want to ask, how does the average person do that? So many of the viewers and listeners, they're working, they're managing a family and all of that. How does the average investor navigate the stock market as you do?
Well, that's a good question. So for me, I try to reduce everything in life to 3 things, and because I can remember 3 things. And so I reduced really investing into 3 important things. You look for businesses with a good valuation. And in our business, that's from a corporate finance perspective. That means price to sales, price to book and price to earnings. So I want to have a business that is valued at a fair price, right? I never want to overpay for a house, a stock, or Hershey bar. So look for traditional valuation, we call it. And then I look for something called downside protection, margin of safety, which I would argue margin of safety is the single most important concept to understand as an investor. Mm-hmm. So again, metaphor. If you build a bridge, a small bridge, and you get 3 cars in the north lane, 3 cars in the south lane, bumper to bumper, that would fit on this bridge. So 6 cars total. You would not build that bridge to withstand the weight of 6 cars. You build a bridge that would withstand the weight of 16 cars, right? You'd build in a margin of safety because you don't know if you're going to have a truck sometime or anything else. And so you want that bridge, no matter what happens, to withstand whatever could happen. That's called margin of safety. As an investor, you're looking for margin of safety, and you ask yourself, if I'm wrong or everything goes wrong, what's this business worth? So there's certain metrics you can look at, like book value, assets minus liabilities. That'll give you your book value. And tangible book, that's without cash. And that will give you some sort of idea of, am I overpaying? Is there a margin of safety in this business? If I'm wrong, what's this business worth? If we use this analogy so many times, John, but if we say to, and this is generically, because I don't want to buy it here, but if we said, oh, I want to buy Coca-Cola, right? I think stock's going up. And we were thinking about margin of safety with a business like Coca-Cola. And we would say to ourselves, well, if we're wrong and the stock doesn't go up, what's my margin of safety? And we'd look at Coca-Cola and recognize, okay, Coca-Cola is the number one recognized English word in the world. We recognize in every 24 hours around the globe, they sell 1.7 billion drinks. It could be water, Fanta, Coca-Cola. And so I would say to myself as an investor, I could be wrong about this stock, but this is maybe one of the most incredible businesses that exists. And there's a certain margin of safety in that business when I buy it. The value of the name, the value of the franchise, the value of all the other businesses they have. It's a tremendous business. And then the third thing I look for is a catalyst. What is going to make this business change? Many times as a value investor, and I said this early, all rational investing is value investing. It's about doing sensible things at sensible prices. So when we look at businesses, we get a good valuation, we get a fair valuation because for whatever reason, either the marketplace, earnings, something's a little bit off, right? If you're going to get a great business at a great price, it's going to be because there may be a short-term event. One of the things about markets, and John Maynard Keynes said that, markets can stay irrational longer than most people can stay alive. So, you can be in a situation where you buy a great business at a great price, but it may not move if there's not a reason for it to move, right? It's not a reason. So I look for a catalyst. You look for, could be a new product, could be new management, could be a big stock buyback. In some of the cases, commodities, it could be a massive move in commodities and a shortage of commodities around the world and stocks like that. So you look for that catalyst that's going to unlock value. And so those 3 things, good valuation, downside protection, margin of safety, and you look for a catalyst that's going to unlock that value and make things appreciate in value.
Excellent. So is it fair to say, kind of summing up those 3 key points, buying good businesses that are well positioned at a good price?
Yes. You want to, and I think the last thing, and I stole this from Charlie Munger, you'd rather pay a fair price for a wonderful business than a wonderful price for a fair business. So you really do want to find those great businesses at great prices. That's the best thing you can try and do.
Excellent. No, that's great. So let's move on and get more specific, shall we? And you talked about the small and the mid-cap stocks. What about the hard assets, Anthony?
Well, I think that's the best question. And I think globally, we have to recognize that 2 things have been going on. One, the money printing that you mentioned, the 11 trillion in debt we've created in the last 4 years. It took us 220 years to create $11 trillion of debt. And we've created an additional 11 trillion in just 4 years. So we've been spending that's unsustainable. It's damaging our economy. So that's number one. And hard asset stocks are businesses. You can buy gold bullion, for instance, and you can hold your gold bars. Costco right now is selling gold, right?
Mhm.
You walk in and you can buy gold at Costco, and they'll sell it to you, and you can pay. Today it's $2,312 an ounce, and you can pay $2,312 and buy gold at Costco. But you also can buy gold mining stocks, and I think this is something that you've heard certain people say today. Well, if I buy gold, I don't, I don't get paid anything. And it's true. If you buy the gold bars, you don't get paid anything. But if you buy Newmont Mining, which is in the S&P 500,
excuse me, Anthony, when you say you don't get paid anything, meaning there's no cash flow from buying a bar of gold. Yeah.
Excellent point. I'm glad you clarified that.
Yeah.
Right. You don't get a dividend when you buy a bar of gold. You're buying that bar of gold today because it's a store of value. It has historically been. And you believe that over time, that bar of gold is going to be worth more money. There's a scarcity, etc. But you can buy businesses that bring the gold out of the ground. And this is fascinating, anecdotal. But if you took all the gold in the world and you melted it, right, it fits in 3 Olympic-sized swimming pools. That's it.
Wow.
So we think, oh, there's gold everywhere. Well, not really. There's not that much of it, and it's hard to get out of the ground, and it's hard to mine, and it's hard to do. It's expensive. It's capital intensive. So it's been a store of wealth throughout the world. Right now, China is buying a ton of gold, right? And I don't know that they know anything, but their central bank is buying a lot. And why are people gravitating towards hard assets? Because they see, oh my gosh, I'm worried about my dollar bills that I have in my pocket. And so, like the 70s, when people are somewhat sensitive to the sort of inflation that we're under, they lean towards hard assets. But how would I get paid in gold? Well, you could buy Newmont Mining. It's in the S&P 500. It's a gold mining stock, and it has a dividend yield of 2.46%. So you can own gold and you can own a mining stock that pays you a dividend at the same time. So that's one way you can get paid in gold. I think we really have to think about these green mandates around the world, John.
Mm-hmm.
Think about how much copper are we going to need? So a combustible engine uses about 54 pounds of copper, and an electric car uses 154 pounds of copper. So you need 3 times as much copper to build a electric car than you do a traditional combustible engine. Well, where's that going to come from? We have seen time and again the regulatory environment, which is banning the exploration and drilling, both here in Canada, for natural assets, for real assets. Last week, it was the Amber Road. That was a road in Canada that had been approved by the Trump administration. There's a massive gold, copper, and cobalt mine available to, pull the assets out of the ground. 2 months into the Biden administration, they stopped the building of the road, the approval process, and then 3 years later, they just decided, no, you can't build a road. So what are we doing? We're demand is increasing for solar mandates, green mandates, all these mandates that drive electrification. So it's beginning to be more and more difficult to get commodities out of the ground in safer parts of the world where you have political stability, and then you have to move to other parts of the world that are less politically stable to get these commodities out of the ground, that are less reliable and more costly. So we're in an environment today where demand is going up and supply is going down, and the ability to get supply where we have it, just like we do in energy, a lot of this is being curtailed for political reasons, not for practical reasons. So that's number one. That's the number one story on commodities. We have a depreciation, a devaluation of our currency, and we have a demand for commodities across the board, including silver, including platinum, including palladium. All of these commodities that are trading at the commodities themselves have moved, but the businesses, the underlying miners that make this stuff and build this stuff, are 30 and 40-year lows. And so the commodities are going up. The stocks have been going down and down and down for a millennium. Let me give you one great stat. This one fascinated me, and I did this specifically for the show. If you looked at gold miners throughout our history, so in 1928, now go 1921, gold companies, gold miners made up about 28% of the market. In 1932, it was about 20%. In 1948, it was 30%. In 1981, it was about 17%, 19%, right between 17 and 19%. Wow. Today, it's 2. Now, what's happened between 1981 and today? What's happened to the value of $1 in 1981? I think it's 5 times was worth more than it is today. So what's changed? Well, we've bought other things and technology and earnings and all these other things. But the reality is, I'm not saying it'll ever go back to 30%. It may never go back to 20%, but it's going to be more than 2%. That I can promise you. So when you asked me this question, and I keep going back to, where do you go find value? Well, I want to buy great businesses. I want to buy value. That's where the value is. You look at kind of historical norms and where we are and what we're doing to our currency. We look at demand for commodities, you know, and I'm going to pivot a little bit here. Think about energy. We are banning drilling everywhere. We just put more barriers up domestically. We're producing 13 million barrels of oil in the United States today. And that makes us the number one producer of energy in the world. So in spite of all the regulation, we're still the number one producer of energy, which is amazing. People think Saudi Arabia, whatever. But that's in spite of the environment we're in. What would that look like if we said, hey, let's be the producer of the world. Let's be the biggest producer of liquid natural gas in the world. What would we look like? And you know, if you're an optimist, and I try to be at times, you would say, well, how would we handle 35 trillion in debt? Well, we think about ways to export natural gas to the world and make money. And that's what we will ultimately have to do, whether they want to admit it today or not. But getting back to your original point, we are at an inflection point.
That's just too common sense, Anthony.
No, but we are at this inflection point right now. You have the opportunity to buy things that are at generational lows, and you have a political and a regulatory environment that are going to see, you know, shortages for the foreseeable future. You can't just say, hey, I'm going to start a copper mine. It's not that easy. It takes at least a decade. Let's start a coal mine. Let's start a silver mine. It's not easy at all. But the demand for silver, the demand for platinum, the demand for palladium, the demand for gold, and as a safe haven is there. So what I'm advising clients is, I think you should have 10% of your assets. Not, you know, if you have a stock market portfolio and you have, you know, stocks, bonds, 60-40 base, you should have at least 10% of your money in things like gold, silver, and you can do them in the stock market in those names. That should be your protection, and it should be no different than you having an insurance policy or an umbrella policy to protect your home, your family, your car, and everything else. We hope that we don't have a currency or a financial crisis, but if we do, you want to have some gold in the ground, and that's kind of, you know, I think the outlook right now.
No, that's good. We got to wrap up here, Anthony. We're out of time, but
Sure.
I did want to get a couple more names from you, stocks that you like.
Yeah, well, I will. A couple that I like right now. A couple big ones I mentioned. Just if you want to play gold, a simple, safe way. Newmont Mining. I love it here. Love it at this price. Got a good yield, safe. You can also buy Barrick Gold, GOLD. So Newmont's NEM Gold is Barrick Gold is GOLD. And then I like a small silver miner, Adriatic Metals. They just came online this year. Trades around $3. Market cap's around 800. They'll do a couple $100 million in revenue. And I have a couple of itty bitty ones that I love, but I'll hold off on those because I like to give you three. Remember, I'll give you three things. I'll give you three great ideas in that space. And also, if you have people that are interested in talking to me, I can certainly leave my email if you have anybody on your show that wants to reach out to me personally.
Absolutely.
And some of the firms that I work with and people I work with in the industry.
Absolutely. We'll get all that information out as we wrap up. But it's just, I had no idea that much copper is required for this ESG movement to build a car, as you said. It's incredible. And that mining is so environmentally friendly, isn't it, Anthony? It's so ridiculous.
Well, if you own Freeport McMoran copper, FTX should keep it and just don't look back. But yeah, we're in a phase over the next 10 years where it's going to be very difficult for supply to meet demand, and how that transpires is who knows? You know, we just don't know. But there's a few things we can know. We can look at valuations today, and on a risk reward basis where you want to be. And that doesn't mean there aren't great businesses and you own them and you've owned them for a long time and they're up a lot. I'm certainly not saying sell them, but I am saying that you should be aware of of this inflection point where I think we are, and really protect yourself.
Yeah.
Last, John, don't have long duration on bonds. Don't own long bonds. Don't keep your durations or your maturities in your bonds and your treasury short. The average investor could buy a 2-year treasury or less and be safe. Own common stocks, but just really, really high quality common stocks, not overpriced. Have some commodities, have some things like gold, silver, some of those commodity names, and they're in stocks that are there to protect you if we do hit some bumpy roads and we hit some turbulence out there, which we undoubtedly will. I think this is going to be very, very difficult 6 months through the election. And we're going to see we continue to see the social unrest and wars around the world. I think it's going to be bumpy. So we want to approach these things with a tremendous amount of caution, but still being opportunistic. Lastly, John, anybody who's on your show wants to talk to me, I'd love to talk, obviously. It's Anthony, Anthony, at fiduciaryarchitects.com. That's fiduciaryarchitects.com, Fiduciary Architects. Send me an email. I love your feedback on the show. Love to talk to you about the markets and so on. And if I could be any help, I'd love to do it.
Awesome. I was going to ask you to wrap up what your final thoughts were, but I think you just hit it. So thank you very much, Anthony. Appreciate that. And for those listening, please take Anthony up on his offer. I mean, he loves to talk about this stuff and give you some guidance and help and show you how to make money in this markets based on the tips, or based on the businesses that he likes right now. So with that, and by the way, I did do a show last week on silver, why I like silver over all commodities right now, mainly because of its scarcity as well as its price and its industrial uses. So you want to check out that show because I think silver has got a long way to go on the upside.
And that's Adriatic Metals, by the way.
Perfect. Thank you for sharing that. Yeah. So I hope you liked the show. Hope you got something out of it. If you did, please leave a comment in the comment section below. Don't forget to hit subscribe. Don't forget my brief video on my cash flow wealth building strategy at go.johnmcgregor.net. With that, have a great week, and we'll see you next time. Take care and aloha. Bye-bye.
Thanks for listening and supporting Full Disclosure. If you like this episode, remember to like and subscribe and follow Full Disclosure. To make a better financial plan for your future, join our Cash Flow Bootcamp, where John shows you a safe and smart way to turn your investments into a steady income stream in a fraction of your time. Learn to make money in any market. Until next time.
This podcast is a presentation of Rich Dad Media Network.